It doesn't matter which of the indexes you look at, whether it's the Nasdaq, the S&P, or the Dow. We're seeing one thing across all three: slow and steady declines really from the start of 2022. The year to date, if we can highlight that, is looking pretty red, with the whole percentage being down by 29.5%. Now with this, if you look at the chart simply, it is a slow and steady decline over the past 5 months really now, and I think a lot of people do get confused, and this is a one thing which I want to highlight with the markets right now. It's something which I'm sure a lot of people are aware of, but equally I'm sure a lot of people are not. Now the market that we're seeing is obviously declining steadily, as I said, and therefore a lot of people think it's just a poor period, it's just a small steady drop, and things are leveling out. It's definitely possible, and nobody knows for sure what is going on. It's impossible to predict with 100% certainty. But one thing that people forget is how market crashes work, and there's some important back context to understand this. For myself and for many others, we first got into investing in 2020. And admittedly, some of us have taken more time than others to figure out how the markets have worked. Now, the crash that we saw in 2020 was like this. It really was just a flash crash, everything really dropped, and there were numerous reasons for that. The graph on screen though does demonstrate how prices went for a lot of things and for the markets as a whole. And this is what people now tend to think of when they see a crash, because let's face it, if you got in 20, you've been here for 2 years now roughly, and you probably haven't seen a crash before. You probably haven't seen how crashes in the past have worked. Now, of course, this is one crash, it definitely is one to consider, but looking back a little bit further than that, we're going to go down to look at some images of different crashes. Now, one which everybody likes to bring up is 2008, and rightly so. So let's find an image for 2008 and see how the market crash worked back then, because it certainly wasn't how it worked about the period of 2020. When it was 2008, we saw a very steady decline over time. So now I've brought up a graph of what happened back in 2008 on the Dow. Sure, it is still a big steep drop, but realistically it's a lot more shallow than what we saw in 2020. And what we saw before the so-called crash actually occurred is we saw this run, and then we had this slow and steady decline over time. Now eventually it did drop off surely, but look, okay, we had a slow and steady decline, and that is really how a crash generally works. Now, to understand why this is, we need to look back to what happened in 2020. In 2020, people were restricted in a way that we haven't seen before, really ever. And it would take intervention on that level, something that bad, to make the markets just completely drop off a cliff overnight like that again, in my opinion. So right now I know a lot of people think we're going through a rough patch in the markets, and I'm not saying that that is not true, but do not be fooled that a crash cannot happen in a slow and steady manner, because those drops of 2, 3, 4, 5% a day on the major indices really are significant, and they do add up over time. And again, a crash is simply when prices do decline. It can be a slow and steady crash, or it can be a flash crash like what we saw. The first one, the slow and steady decline, is the more likely option, so do consider that when you're looking at the markets.